What if everything you've been told about building wealth is completely backwards? Most people assume investing requires a financial advisor, a complex strategy, and the ability to predict market movements. But one investor spent decades making every possible mistake and eventually discovered a system so simple it almost feels like it should not work, the one that mathematically beats over 82% of professional fund managers. And after 30 years, that number climbs even higher, and anyone can start using it today. This video is based on The Simple Path to Wealth by J.L. Collins, originally written as a series of letters to his daughter, later expanded into one of the most direct personal finance books ever published. Collins is not a theorist. He lived his system, made the costly mistakes, and distilled everything into something genuinely teachable. The financial industry profits from complexity. The more overwhelming investing seems, the more dependent you become on expensive products and advisors that quietly drain your returns through fees, and those fees, compounded over decades, can cost you hundreds of thousands of dollars. Meanwhile, the simple approach, the one that consistently outperforms, has been available all along. This book hands you that system. The entire path reduces to 3 moves: avoid debt, spend significantly less than you earn and invest the surplus in low-cost index funds. Then leave it alone. No stock picking, no market timing, no advisor required. And the real goal is never retirement. It is financial independence, the point at which your investments generate enough to cover your life entirely, and you decide what comes next on your own terms. Freedom, not stuff. Before any tactic, the why has to come first. Most people think money is for buying things. Collins reframes this completely. Money is for buying options, time, leverage, and the power to say no to anything that no longer serves you. Until that shift happens, every financial decision is aimed at the wrong target. FU money. He calls this FU money. Not millions in the bank, just enough of a financial buffer to negotiate from a position of strength. At 25, Collins had saved $5,000 and asked his employer for unpaid leave. His boss said no. He resigned. Then his boss reversed course. That $5,000 did not buy luxury. It bought leverage. And from that moment, he never felt financially trapped again. FI equals freedom to choose. Financial independence is not about stopping work forever. It is about making work optional. Some people keep going after reaching FI, but now by genuine choice, not out of necessity. Lower costs, faster FI. And the lower your lifestyle costs, the smaller your FI target becomes, and the faster you reach it. Living lean is not deprivation. It is the fastest vehicle. On the road to freedom, you are not building wealth to accumulate a number. You are building it to reclaim your life. But none of that is achievable while debt is draining your income every month, which is exactly where most people need to begin. Destroy debt, maximize savings. Debt is not a neutral tool. It is a mechanism that transfers your future wealth to someone else's present. Every dollar in interest is a dollar that cannot compound for you. Collins is direct. Trying to build wealth while carrying debt is draining a tank with the valve still open. Above 5%, eliminate now. His decision rule is clear. Above 5% interest, eliminate that debt. Before any extra investing, between 3 and 5%, use your judgment. Below 3%, make minimum payments only, and put everything else to work in the market. Student loans unforgivable. Student loans require a specific warning. Unlike every other form of debt, they cannot be erased in bankruptcy. They follow you for life, which makes them qualitatively more dangerous than a mortgage or a credit card. 50% savings rate. The savings target Collins recommends is 50% of income. It sounds extreme until you understand what it achieves: more capital to invest and a trained ability to live on less, which permanently lowers your FI number. Capital up needs down. Saving more does two jobs at once. It grows the investment side and shrinks the lifestyle cost side. You move toward freedom faster from both ends simultaneously. Once debt is gone and savings are flowing, the next challenge is purely mental. How you actually think about every dollar that comes in. Compounding, not spending. This is a mindset shift. Most spending decisions get made with one question: can I afford this? Collins says that is the wrong question entirely. The right one is, what does this cost me in future freedom? Spending kills compounding. When you spend $1, you do not just lose that dollar, you permanently lose every dollar it would have generated. Through compounding across your entire lifetime, the real cost of any purchase is never just a price tag. 8% proxy rule. Collins uses an 8% annual return as a reference point. A $20,000 car costs $1,600 per year in lost investment earnings every single year forever. Walk that math forward over 30 years, accounting for compounding, and the real cost of that car is staggering. Cost in future freedom. This does not mean never spending. It means spending with full awareness of the actual trade-off. Before any major purchase, ask one question: what does this cost me? In future freedom, every dollar kept invested works toward freeing you. Every unnecessary dollar spent is a dollar that will never compound again. So where does this money actually go? Collins's answer is almost offensively simple. Own the market. The investment strategy fits in one sentence by the entire U.S. stock market through a single low-cost index fund. The fund is VTSAX, Vanguard's Total Stock Market Index Fund. It holds every publicly traded U.S. company and charges a fraction of what any active fund costs. One fund, VTSAX. During the accumulation phase, while working and saving, 100% goes into VTSAX. It grows with the market, hedges against inflation, and requires no active decisions from you. VTLX preservation stage. When you shift to living off your portfolio, you add VTLX bonds to reduce volatility and hedge against deflation. How much you hold depends on your real tolerance for a portfolio drop, not a formula based on your age. Lump sum beats DCA. When a large sum is ready to invest, deploy it immediately. The market rises roughly 77% of the time. Waiting to feel safer statistically costs you returns. No international funds. You do not need a separate international fund. VTSAX already includes companies operating globally. TRFF simplest path for those who want. Zero ongoing decisions. Target retirement funds. Handle rebalancing automatically for life. Collins calls them the simplest path of all. Avoid AUM advisors. Avoid advisors charging 1 to 2% of your assets annually. Compounded over 30 years, that fee costs hundreds of thousands. Vanguard's client-owned structure eliminates this conflict entirely. Low costs are not a marketing strategy there. They are a structural inevitability. The strategy is simple. What is not simple is staying in when everything around you says get out. Psychology is real risk. The strategy is clear. What is not clear is watching your portfolio fall 40% while the news declares financial collapse and doing nothing. This is where most investors fail, not because they picked the wrong fund, because they reacted to the wrong emotion. Crashes are buying opportunities. Market crashes are not emergencies. They are predictable, scheduled features of long-term investing. For investors still in the accumulation phase, a drop is not a threat. It is a sale. The same assets you have been buying now available at a discount. Fear sells, greed buys. The pattern is consistent. Fear drives selling at the bottom. Greed drives buying near the top. Both permanently destroy wealth. Every investor who sold during the 2008 crash locked in losses and missed the complete recovery that followed. Think shares, not price. Reframe how you track your portfolio. You do not own a fluctuating dollar number. You own a specific count of shares in real companies. During a price drop, that share count does not change. Your ownership is intact. Conviction before crash. Decide how you will behave during a crash, before it happens, not while the headlines are screaming. Investors who build that conviction in calm markets are the ones who stay the course when it truly counts. Stay in long enough, compound consistently, and eventually you reach the moment this entire system is aimed at. FI finish line. There is a precise moment when the system completes its job. Collins defines it with one formula: when 4% of your invested assets covers your annual expenses, you are financially independent. Take your annual spending, divide by 0.4. That is your number. FI target formula. Spend $40,000 per year. Target $1,000,000. Spend $30,000. Target $750,000. The number is calculable today, which means you can track real progress starting right now. Flexibility is safety net. The 4% rule carries a roughly 96% historical success rate over 30+ years. The real safety net is not the math. It is your willingness to slightly reduce spending during severe downturns when necessary. Tax priority order. While building toward FI, sequence your accounts correctly. Capture the full employer 401k match first. That is free money. Then fund an IRA or Roth IRA based on your income level. Then max the 401k. Taxable accounts come last. HSA triple tax win. The health savings account is the most overlooked tool in the book. Contributions are tax deductible, growth is tax-free, and medical withdrawals are tax-free. Invested in VTSAX and leave it untouched for decades. Roth conversions. Avoid RMDs. One late game warning. Large tax-deferred balances trigger required minimum distributations after age 70 and a half, which can push your tax bracket unexpectedly higher. Doing Roth conversions during your lowest income years neutralizes this risk before it arrives. 6 ideas, 1 system. Stop treating debt as normal. Apply Collins's threshold rule immediately. Raise your savings rate and watch your FI target shrink from both ends. Before major purchases, run the opportunity cost math. Put your money in VTSAX and stop touching it. When the market drops, remind yourself you still own the same shares and consider buying more. Calculate your FI number today, then maximize every tax shelter available on the path there. The system is simple. The discipline is the entire job. Collins spent decades believing wealth building was complicated. Then he realized the complexity was manufactured, designed to keep him dependent on an industry that profited from his confusion. The simple path was always there. Avoid debt, save aggressively, own the market cheaply, Stay the course. That is the entire system, and it works for almost anyone willing to follow it. Subscribe for more book breakdowns like this and find the purchase link in the description below.